Welcome to this exam review from Birdsey, your AI-powered study partner. Be sure to like and subscribe for more videos. Let's get started.
Let's start with a review of federal mortgage-related laws. Real Estate Settlement Procedures Act. What is the primary purpose of the Real Estate Settlement Procedures Act? Is it A, to ensure consumers receive disclosures about real estate transaction costs? B, to regulate the interest rates on mortgage loans? C, to provide tax benefits for first-time homebuyers? Or D, to establish guidelines for real estate agent commissions? The answer is A, to ensure consumers receive disclosures about real estate transaction costs. RESPA's main goal is to protect consumers by ensuring they receive important disclosures about the costs of their real estate transactions. Under RESPA, which of the following is not considered a settlement service? Is it A, title insurance, B, appraisal services, C, home inspection services, or D, credit report services? The answer is C, home inspection services. Why this question may seem a bit tricky. The term settlement service can be broad, but it specifically excludes services not directly related to the settlement process. John is purchasing a home and receives a good faith estimate from his lender. What is the purpose of this document in the context of RESPA? Is it A, to finalize the interest rate on John's mortgage? B, to provide an estimate of settlement charges John will incur? C, to serve as a binding contract for settlement costs? Or D, to outline the terms of John's mortgage loan? The answer is B, to provide an estimate of settlement charges John will incur. The GFE provides an estimate of the settlement charges John will likely incur, helping him understand and compare costs. Which of the following transactions is covered by RESPA? Is it A, a cash purchase of a commercial property? B, a loan for a 5-unit apartment building? C, a personal loan for home improvements? Or D, a mortgage loan for a single-family home? The answer is D, a mortgage loan for a single-family home. RESPA applies to federally related mortgage loans, including those for 1 to 4 family residential properties. Lisa, a real estate agent, receives a referral fee from a title company for recommending their services. Is this practice compliant with RESPA? Is it A, yes, as long as the fee is disclosed to the client? B, no, because RESPA prohibits referral fees for settlement services? C, yes, if the fee is less than a certain percentage of the transaction? Or D, no, unless the title company is also providing a service to the client? The answer is B, no, because RESPA prohibits referral fees for settlement services. RESPA prohibits kickbacks and referral fees for settlement services, making this practice non-compliant. Truth in Lending Act and Regulation Z. What is the primary purpose of the Truth in Lending Act? Is it A, to promote informed use of consumer credit by requiring disclosures about its terms and cost? B, to regulate the interest rates that lenders can charge? C, to provide insurance for mortgage loans? Or D, to enforce fair lending practices? The answer is A, to promote informed use of consumer credit by requiring disclosures about its terms and cost. TILA's primary purpose is to promote informed use of consumer credit by requiring disclosures about its terms and cost. Under TILA, which of the following is not considered a finance charge? Is it A, interest payments, B, loan origination fees, C, credit insurance premiums, or D, late payment fees? The answer is D, late payment fees. Why this question may seem a bit tricky. Finance charges include most costs associated with borrowing, but some fees, like late payment fees, are excluded. John is refinancing his home and receives a loan estimate under TILA, What must the lender ensure regarding the APR disclosure? Is it A, the APR must be disclosed within 3 days of application? B, the APR must be disclosed only if it changes? C, the APR must be disclosed accurately within tolerance limits? Or D, the APR must be disclosed after the loan is finalized? The answer is C. The APR must be disclosed accurately within tolerance limits. The lender must ensure the APR is disclosed accurately within the tolerance limits set by TILA. Which document is required by TILA to be provided to consumers within 3 business days of receiving a mortgage application? Is it A, closing disclosure? B, loan estimate? C, mortgage note? Or D, deed of trust? The answer is B, loan estimate. The loan estimate must be provided within 3 business days to inform consumers of key loan terms and costs. Sarah is considering a home equity line of credit and receives disclosures under TILA. What must be included in these disclosures? Is it A, the terms and conditions of the HELOC, including the APR and payment terms? B, the lender's profit margin on the HELOC? C, the borrower's credit score? Or D, the estimated property value? The answer is A, the terms and conditions of the HELOC, including the APR and payment terms. TILA requires that the terms and conditions of the EPLOC, including the APR and payment terms, be disclosed.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsey.ai for immediate help and a free study session with Birdsey, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
Home Ownership and Equity Protection Act, HOEPA. What is the primary purpose of the Home Ownership and Equity Protection Act, HOEPA? Is it A, to protect consumers from predatory lending practices? B, to regulate interest rates on all mortgage loans? C, to provide tax benefits for first-time homebuyers? Or D, to standardize mortgage application processes? The answer is A, to protect consumers from predatory lending practices. HOEPA was enacted to protect consumers from predatory lending practices by imposing restrictions on high-cost loans and requiring additional disclosures. Which of the following triggers a loan to be classified as a high-cost mortgage under HOEPA? Is it A, any interest rate above 10%? B, a loan amount exceeding $500,000? C, points and fees exceeding a certain percentage of the loan amount? Or D, a loan term shorter than 15 years? The answer is C, points and fees exceeding a certain percentage of the loan amount. Why this question may seem a bit tricky. The triggers for a high-cost mortgage include specific APR thresholds, points and fees, and prepayment penalties, not just any high interest rate. John is considering a mortgage with an APR that exceeds the average prime offer rate by more than 6.5%. Under HOEPA, what must the lender do before proceeding? Is it A, offer a lower interest rate to avoid HOEPA classification? B, provide additional disclosures and ensure borrower counseling? C, require a larger down payment from John? Or D, extend the loan term to reduce monthly payments? The answer is B, provide additional disclosures and ensure borrower counseling. The lender must provide additional disclosures and ensure the borrower receives counseling as the loan is considered high cost under HOEPA. What type of loans does HOEPA primarily regulate? Is it A, all conventional mortgages? B, FHA loans only? C. VA loans only. Or D. High-cost mortgages. The answer is D. High-cost mortgages. HOEPA primarily regulates high-cost mortgages, which are loans with terms that exceed certain thresholds for interest rates and fees. Sarah's lender is offering her a loan with a prepayment penalty. Under HOEPA, what must the lender ensure? Is it A. The prepayment penalty does not exceed HOEPA's limits? B. A loan term is extended to reduce monthly payments? C. The interest rate is reduced to compensate for the penalty? Or D. The penalty is waived if Sarah refinances within 2 years? The answer is A. The prepayment penalty does not exceed HOEPA's limits. The lender must ensure the prepayment penalty does not exceed HOEPA's limits, which are designed to protect borrowers from excessive fees. Equal Credit Opportunity Act. What is the primary purpose of the Equal Credit Opportunity Act? Is it A. To prevent discrimination in credit transactions? B. To regulate interest rates on mortgages? C. To provide grants for first-time homebuyers? Or D. To ensure lenders disclose all loan terms? The answer is A. To prevent discrimination in credit transactions. The ECOA aims to prevent discrimination in credit transactions based on race, color, religion, national origin, sex, marital status, age, or because someone receives public assistance. Under the ECOA, which of the following is not a prohibited basis for credit discrimination? Is it A. Race, B. Age, C. Credit score, or D. Marital status? The answer is C. Credit score. Why this question may seem a bit tricky, the ECOA prohibits discrimination based on several factors, but credit score is not one of them, as it is a legitimate factor in credit decisions. A lender denies a loan application because the applicant is 17 years old. Is this action compliant with the ECOA? Is it A. Yes, because the applicant is not of legal age to contract? B. No, because age discrimination is prohibited? C. Yes, because the applicant's income is too low? Or D. No, because the applicant's age should not be considered? The answer is A. Yes, because the applicant is not of legal age to contract. The ECOA allows lenders to consider age if the applicant is not legally able to enter into a contract, such as being under 18. Which of the following actions is required by the ECOA when a credit application is denied? Is it A. Provide a free credit report? B. Provide a notice of adverse action? C. Offer a lower interest rate? Or D. Automatically approve the next application? The answer is B. Provide a notice of adverse action. The ECOA requires lenders to provide a notice of adverse action explaining the reasons for denial to the applicant. Fair Credit Reporting Act and FACTA. Under the Fair Credit Reporting Act, how long can negative information generally remain on a consumer's credit report? Is it A. 3 years, B. 5 years, C. 7 years, or D. 10 years? The answer is C. 7 years. Negative information, such as late payments, can generally remain on a credit report for up to 7 years. This is a standard period set by the FCRA to ensure that consumers are not indefinitely penalized for past financial mistakes. Which of the following is not a requirement under the Fair and Accurate Credit Transactions Act for businesses handling consumer information? Is it A. Secure disposal of consumer information? B. Providing free credit scores to consumers? C. Implementing identity theft prevention programs? Or D. Truncating credit card numbers on receipts? The answer is B. Providing free credit scores to consumers. Why this question may seem a bit tricky. FACTA has specific rules about handling consumer information, but not all common practices are mandated by it. For example, while secure disposal is required, providing free credit scores is not a FACTA requirement. John is applying for a mortgage and discovers an error on his credit report. What is the first step he should take according to the Fair Credit Reporting Act? Is it A, contact the credit reporting agency to dispute the error? B, contact the lender to resolve the issue? C, wait for the error to be corrected automatically? Or D, hire a credit repair company? The answer is A, contact the credit reporting agency to dispute the error. John should first contact the credit reporting agency to dispute the error. The FCRA provides consumers the right to dispute inaccurate information and requires agencies to investigate disputes. What is one of the main purposes of the Fair Credit Reporting Act? Is it A, to provide free credit scores to consumers? B, to regulate interest rates on loans? C, to eliminate all negative credit information? Or D, to ensure accuracy and privacy of consumer information? The answer is D, to ensure accuracy and privacy of consumer information. The FCRA aims to ensure the accuracy, fairness, and privacy of information in the files of consumer reporting agencies. It sets guidelines for how consumer information is collected and used.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsey.ai for immediate help and a free study session with Birdsey, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
Emily receives her credit report and notices a debt she doesn't recognize. Under the FCRA, what can she do to address this issue? Is it A, ignore it, as it will eventually be removed? B, contact the creditor directly to remove it? C, dispute the debt with the credit reporting agency? Or D, request a new credit report from a different agency? The answer is C, dispute the debt with the credit reporting agency. Emily can dispute the debt with the credit reporting agency. The FCRA requires agencies to investigate disputes and correct any inaccuracies found. Home Mortgage Disclosure Act. What is the primary purpose of the Home Mortgage Disclosure Act? Is it A, to regulate interest rates on mortgages? B, to provide public data on mortgage lending practices? C, to enforce anti-discrimination laws in housing? Or D, to set standards for mortgage underwriting? The answer is B, to provide public data on mortgage lending practices. The HMDA main goal is to provide public data that can be used to determine whether financial institutions are serving the housing needs of their communities. Which of the following institutions is not required to report under HMDA? Is it A, a bank with over $50 million in assets? B, a credit union with a home office in the U.S.? C, a small mortgage broker with no physical office? Or D, a savings association with a branch in a metropolitan area? The answer is C, a small mortgage broker with no physical office. Why this question may seem a bit tricky. The distinction lies in the type of institution and its activity. Only certain financial institutions with specific criteria are required to report. A bank in a metropolitan area is reviewing its HMDA data for accuracy before submission. What is the primary reason for this review? Is it A, to ensure compliance with HMDA requirements? B, to determine the bank's profitability? C, to prepare for a marketing campaign? Or D, to adjust interest rates on future loans? The answer is A, to ensure compliance with HMDA requirements. Ensuring data accuracy is crucial for compliance with HMDA, as it affects public data integrity and fair lending analysis. Which data point is not required to be reported under HMDA? Is it A, loan amount, B, borrower's ethnicity, C, property location, or D, borrower's credit score? The answer is D, borrower's credit score. Why this question may seem a bit tricky, the confusion often arises from the detailed nature of HMDA reporting requirements. Other federal laws: SAFE Act, Privacy, Do Not Call, Patriot Act. What is the primary purpose of the SAFE Act in relation to mortgage loan originators? Is it A, to provide financial assistance to first-time homebuyers, B, to establish minimum standards for licensing and registration of mortgage loan originators, C, to regulate interest rates on mortgage loans, or D, to provide tax incentives for mortgage lenders? The answer is B, to establish minimum standards for licensing and registration of mortgage loan originators. The SAFE Act was established to enhance consumer protection and reduce fraud by setting minimum standards for licensing and registration of mortgage loan originators. Under the Do Not Call rules, how long can a company call a consumer after an inquiry? Is it A, indefinitely, as long as the consumer has not opted out, B, 6 months from the date of inquiry, C, 3 months from the date of inquiry, or D, 1 year from the date of inquiry? The answer is C, 3 months from the date of inquiry. Why this question may seem a bit tricky, the rules allow calls for up to 3 months after an inquiry, which can be confused with other timeframes for different consumer interactions. Jessica, a mortgage loan originator, receives a call from a potential client who is on the Do Not Call list but had inquired about services 2 months ago. What is Jessica allowed to do? Is it A, call the potential client since the inquiry was made within the last 3 months, B, ignore the Do Not Call list because the client inquired about services, C, wait until the client calls back to ensure compliance, or D, send a text message instead of calling? The answer is A, call the potential client since the inquiry was made within the last 3 months. Jessica can call the potential client because the inquiry was made within the 3-month period allowed by the Do Not Call rules. What is a key requirement of the Patriot Act for financial institutions? Is it A, to provide free credit reports to consumers annually, B, to offer lower interest rates to veterans, C, to ensure all employees are licensed mortgage loan originators, or D, to establish anti-money laundering programs? The answer is D, to establish anti-money laundering programs. The Patriot Act requires financial institutions to establish anti-money laundering programs to prevent and detect money laundering activities.
Finding this exam review helpful? If you haven't already, like and subscribe for more videos that'll get you ready to pass.
General mortgage knowledge. Mortgage loan products, conventional, FHA, VA, USDA. What is the primary benefit of a VA loan for eligible veterans? Is it A, lower interest rates, B, no down payment required, C, no private mortgage insurance, or D, flexible credit requirements? The answer is B, no down payment required. VA loans offer eligible veterans the benefit of no down payment, making homeownership more accessible without the need for upfront cash. Which type of mortgage loan typically requires mortgage insurance regardless of the down payment amount? Is it A, conventional loan, B, VA loan, C, FHA loan, or D, USDA loan? The answer is C, FHA loan. Why this question may seem a bit tricky. FHA loans require mortgage insurance regardless of the down payment, unlike conventional loans where a 20% down payment can eliminate PMI. John is a first-time homebuyer with limited savings and is considering a loan with a low down payment. Which loan product is most suitable for him? Is it A, FHA loan, B, conventional loan, C, VA loan, or D, USDA loan? The answer is A, FHA loan. FHA loans are ideal for first-time buyers with limited savings due to their low down payment requirement of 3.5%. What is a key feature of USDA loans? Is it A, available only to veterans, B, requires a minimum 5% down payment, C, only available for urban properties, or D, no down payment required? The answer is D, no down payment required. USDA loans offer 100% financing, meaning no down payment is required, which is a significant advantage for eligible rural homebuyers. Loan terms, features, and fixed versus adjustable rate mortgages. What is the primary difference between a fixed rate mortgage and an adjustable rate mortgage? Is it A, a fixed rate mortgage has a constant interest rate, while an adjustable rate mortgage can change? B, a fixed rate mortgage can change rates annually, while an adjustable rate mortgage is fixed? C, both have variable interest rates, but differ in payment terms? Or D, a fixed rate mortgage is only available for 15-year terms, while adjustable rate mortgages are for 30 years? The answer is A, a fixed rate mortgage has a constant interest rate, while an adjustable rate mortgage can change. A fixed rate mortgage has a constant interest rate throughout the loan term, while an adjustable rate mortgage has an interest rate that can change periodically. Which feature is typically associated with an adjustable rate mortgage? Is it A, a fixed interest rate for the life of the loan, B, interest rate caps that limit how much the rate can change, C, a balloon payment at the end of the loan term, or D, a prepayment penalty for early payoff? The answer is B, interest rate caps that limit how much the rate can change. Why this question may seem a bit tricky. The term cap might confuse test takers into thinking it applies to fixed-rate mortgages, but it actually refers to limits on rate changes in adjustable rate mortgages. John is considering a mortgage that starts with a low interest rate for the first 5 years and then adjusts annually. What type of mortgage is he likely considering? Is it A, a fixed-rate mortgage, B, a balloon mortgage, C, an adjustable rate mortgage, or D, a reverse mortgage? The answer is C, an adjustable rate mortgage. John is considering an adjustable rate mortgage, specifically a 5-1 ARM, where the rate is fixed for the first 5 years and adjusts annually thereafter. What does the term amortization refer to in a mortgage context? Is it A, the initial down payment on a mortgage, B, the interest rate adjustment period, C, the total interest paid over the life of the loan, or D, the process of paying off a loan with regular payments? The answer is D, the process of paying off a loan with regular payments. Amortization refers to the process of gradually paying off a debt over time through regular payments of principal and interest. Primary and secondary mortgage markets. What is the primary purpose of the secondary mortgage market? Is it A, to originate new loans for borrowers, B, to provide liquidity to lenders by purchasing existing mortgages, C, to set interest rates for new mortgage loans, or D, to insure mortgages against default? The answer is B, to provide liquidity to lenders by purchasing existing mortgages. The secondary mortgage market exists to provide liquidity to lenders by allowing them to sell mortgages, thus freeing up capital to issue more loans. Which entity is most commonly associated with the securitization of mortgages in the secondary market? Is it A, Fannie Mae, B, Freddie Mac, C, Ginnie Mae, or D, Federal Reserve? The answer is A, Fannie Mae. Why this question may seem a bit tricky, Fannie Mae and Freddie Mac are often confused, but Fannie Mae is more commonly associated with securitization. A lender sells a bundle of mortgages to an investment firm to free up capital for new loans. What role is the investment firm playing in this transaction? Is it A, primary lender, B, mortgage insurer, C, secondary market participant, or D, loan servicer? The answer is C, secondary market participant. The investment firm is acting as a participant in the secondary mortgage market by purchasing existing mortgages. What is a mortgage-backed security? Is it A, a loan provided to a borrower for purchasing a home, B, an insurance policy protecting lenders from borrower default, C, a government bond issued to fund housing projects, or D, an investment product backed by a pool of mortgages? The answer is D, an investment product backed by a pool of mortgages. An MBS is a type of investment that is secured by a collection of mortgages, allowing investors to receive payments from the mortgage interest and principal. Mortgage loan servicing and payment structures. What is the primary purpose of mortgage loan servicing? Is it A, to originate new loans, B, to manage loan accounts and collect payments, C, to sell loans to investors, or D, to refinance existing loans? The answer is B, to manage loan accounts and collect payments. The primary purpose of mortgage loan servicing is to manage the loan account, including collecting payments, managing escrow accounts, and handling customer service inquiries. What happens if a borrower makes a partial payment on their mortgage? Is it A, the partial payment is immediately applied to the principal, B, a lender waives any late fees, C, the payment is held in a suspense account until full payment is received, or D, the borrower receives a credit on their next payment? The answer is C, the payment is held in a suspense account until full payment is received. Why this question may seem a bit tricky, partial payments are often not applied to the loan balance until the full payment is received, which can lead to late fees or penalties. John has an adjustable rate mortgage and is concerned about rising interest rates. What should he consider doing to manage his mortgage payments? Is it A, ignore the interest rate changes, B, switch to a bi-weekly payment plan, C, request a loan modification, or D, refinance to a fixed-rate mortgage? The answer is D, refinance to a fixed-rate mortgage. John should consider refinancing to a fixed-rate mortgage to stabilize his payments against rising interest rates. What is an escrow account used for in mortgage servicing? Is it A, to hold funds for property taxes and insurance, B, to store excess funds from mortgage payments, C, to manage the principal balance of the loan, or D, to invest in the stock market? The answer is A, to hold funds for property taxes and insurance. An escrow account is used to hold funds for property taxes and insurance, ensuring these are paid on time. Qualified mortgage and ability-to-repay standards. What is the maximum debt-to-income ratio allowed for a qualified mortgage under the ability-to-repay rule? Is it A, 36%, B, 41%, C, 43%, or D, 45%? The answer is C, 43%. The maximum DTI ratio for a qualified mortgage is 43%. This ensures borrowers have the ability to repay their loans without undue financial strain. Which of the following is not a requirement for a loan to be considered a qualified mortgage? Is it A, no negative amortization, B, no balloon payment, C, no interest-only payments, or D, loan term of 30 years or less? The answer is B, no balloon payment. Why this question may seem a bit tricky, the options include features that are often confused with QM requirements. The absence of negative amortization is a requirement, but the absence of a balloon payment is not always a requirement. John is applying for a mortgage with a DTI ratio of 44% and no balloon payment. Can this loan be considered a qualified mortgage? Is it A, yes, because the DTI ratio is within acceptable limits? B, yes, because there is no balloon payment? C, no, because the loan term exceeds 30 years? Or D, no, because the DTI ratio exceeds the maximum allowed? The answer is D, no, because the DTI ratio exceeds the maximum allowed. John's DTI ratio exceeds the 43% limit for a qualified mortgage, making it ineligible despite the absence of a balloon payment. What is one of the primary purposes of the Ability-to-Repay rule? Is it A, to ensure lenders verify a borrower's repayment ability? B, to allow lenders to charge higher interest rates? C, to eliminate all adjustable rate mortgages? Or D, to provide government-backed insurance for all loans? The answer is A, to ensure lenders verify a borrower's repayment ability. The Ability-to-Repay rule is designed to ensure lenders verify a borrower's ability to repay a loan, reducing the risk of default. Mortgage loan origination activities. Application process and uniform residential loan application. What is the primary purpose of the uniform residential loan application? Is it A, to provide a legal contract between lender and borrower? B, to collect detailed financial information from the borrower? C, to determine the interest rate for the loan? Or D, to finalize the terms of the mortgage agreement? The answer is B, to collect detailed financial information from the borrower. URLA is designed to collect comprehensive information about a borrower's financial situation to assess their creditworthiness for a mortgage loan. Which section of the URLA is specifically designed to capture information about the borrower's employment history? Is it A, Section 1, Borrower Information? B, Section 2, Financial Information, Assets and Liabilities? C, Section 4, Employment Information? Or D, Section 5, Monthly Income and Combined Housing Expense Information? The answer is C, Section 4, Employment Information. Why this question may seem a bit tricky, the URLA contains multiple sections and it's easy to confuse employment history with other financial sections. During the mortgage application process, Sarah realizes she made an error in her employment history on the URLA. What should she do to correct this? Is it A, contact her loan officer to update the application? B, submit a new application with the correct information? C, wait until the loan is approved to mention the error? Or D, ignore the error as it's not significant? The answer is A, contact her loan officer to update the application. Sarah should contact her loan officer to amend the application, ensuring all information is accurate before processing. What information is typically required in the Assets and Liabilities section of the URLA? Is it A, only the borrower's current income? B, the borrower's employment history? C, the borrower's credit score? Or D, details of the borrower's bank accounts and debts? The answer is D, details of the borrower's bank accounts and debts. This section requires details about the borrower's financial assets and liabilities to assess their financial stability. Processing and underwriting. What is the primary purpose of a debt-to-income ratio in mortgage underwriting? Is it A, to assess a borrower's ability to manage monthly payments? B, to determine the interest rate for the loan? C, to calculate the loan-to-value ratio? Or D, to establish the loan term? The answer is A, to assess a borrower's ability to manage monthly payments. The DTI ratio is used to assess a borrower's ability to manage monthly payments and repay debts. It compares the borrower's total monthly debt payments to their gross monthly income. In mortgage underwriting, which factor is least likely to affect the approval of a loan application? Is it A, credit score, B, borrower's age, C, income stability, or D, employment history? The answer is B, borrower's age. Why this question may seem a bit tricky. All factors listed can impact loan approval, but the borrower's age is not directly considered in underwriting decisions, unlike credit score, income, and employment history. Sarah is applying for a mortgage and her credit report shows a recent late payment. How might this affect her loan application? Is it A, it will automatically disqualify her from obtaining a loan? B, it will have no impact if her income is sufficient? C, it may result in higher interest rates or stricter terms? Or D, it will require her to provide additional documentation? The answer is C, it may result in higher interest rates or stricter terms. A recent late payment can negatively impact Sarah's credit score, potentially leading to higher interest rates or stricter loan terms. John, a loan officer, is reviewing a borrower's application and notices discrepancies in reported income. What should he do next? Is it A, approve the loan based on initial information? B, request additional documentation to verify income? C, ignore the discrepancies if the credit score is high? Or D, decline the application immediately? The answer is B, request additional documentation to verify income. John should request additional documentation to verify the borrower's income, ensuring accuracy before proceeding with the application.
Notice the code in the corner? When you're stumped by a question, enter it at birdsey.ai for immediate help. Enjoy complimentary study sessions and access to hundreds of additional questions to help you pass your exam with confidence.
Appraisals and valuation practices. What is the primary purpose of an appraisal in the mortgage loan origination process? Is it A, to determine the market value of the property? B, to inspect the property for structural issues? C, to negotiate the sale price between buyer and seller? Or D, to ensure the property complies with local zoning laws? The answer is A, to determine the market value of the property. An appraisal determines the market value of a property, which helps lenders assess the risk of the loan. It ensures the property value supports the loan amount. Which factor is least likely to directly affect a property's appraised value? Is it A, recent sales of similar properties? B, the condition of the property? C, location and neighborhood characteristics? Or D, the appraiser's personal opinion? The answer is D, the appraiser's personal opinion. Why this question may seem a bit tricky. All options seem relevant, but the appraiser's personal opinion should not directly affect the value, as they rely on objective data. During a mortgage loan process, an appraiser finds that the property has an illegal addition. How should this affect the appraisal report? Is it A, ignore the addition and proceed with the appraisal? B, include the addition in the report and adjust the value accordingly? C, exclude the addition from the appraisal report? Or D, recommend the removal of the addition before proceeding? The answer is B, include the addition in the report and adjust the value accordingly. The appraiser should note the illegal addition in the report as it can affect the property's marketability and value. What is a common method used by appraisers to determine the value of a residential property? Is it A, income capitalization approach, B, cost approach, C, sales comparison approach, or D, gross rent multiplier? The answer is C, sales comparison approach. A sales comparison approach is commonly used for residential properties, comparing recent sales of similar homes. Closing and settlement process. What document is typically used to itemize all closing costs, including lender fees, for a mortgage transaction? Is it A, loan estimate, B, closing disclosure, C, promissory note, or D, deed of trust? The answer is B, closing disclosure. The closing disclosure is used to itemize all closing costs, including lender fees, in a mortgage transaction. Which party is responsible for ensuring that the closing disclosure is delivered to the borrower at least 3 business days before closing? Is it A, lender, B, closing agent, C, borrower, or D, real estate agent? The answer is A, lender. Why this question may seem a bit tricky. The lender, not the closing agent or borrower, is responsible for ensuring timely delivery of the closing disclosure. During a closing meeting, Sarah notices a discrepancy in the loan amount on the closing disclosure compared to her loan estimate. What should she do first? Is it A, sign the documents and address it later, B, contact her real estate agent immediately, C, ask the closing agent for clarification, or D, refuse to proceed with the closing? The answer is C, ask the closing agent for clarification. Sarah should first ask the closing agent for clarification to understand the discrepancy before proceeding. What is the primary purpose of a title search in the closing process? Is it A, to determine the property value, B, to verify the borrower's creditworthiness, C, to calculate property taxes, or D, to ensure clear ownership of the property? The answer is D, to ensure clear ownership of the property. A title search ensures there are no liens or claims against the property that could affect ownership. John is at the closing table and realizes he doesn't understand a fee listed on the closing disclosure. What is the most appropriate action for him to take? Is it A, ignore it and proceed with signing, B, ask the closing agent for an explanation, C, call his lender for clarification, or D, assume it's a standard fee and continue? The answer is B, ask the closing agent for an explanation. John should ask the closing agent to explain the fee to ensure he understands all costs before signing. Calculation and disclosure of loan costs, APR, finance charges, points. What does APR stand for in mortgage loan origination? Is it A, annual payment rate, B, average payment rate, C, annual percentage rate, or D, annual principal rate? The answer is C, annual percentage rate. APR stands for annual percentage rate, which reflects the true cost of borrowing by including interest and other fees. Which of the following is included in the calculation of the finance charge for a mortgage loan? Is it A, title insurance fees, B, loan origination fees, C, property taxes, or D, homeowner's insurance? The answer is B, loan origination fees. Why this question may seem a bit tricky. Finance charges include interest and fees directly related to the loan, but not all fees are included, such as title insurance. John is applying for a mortgage and is presented with an APR of 4.5% and a nominal interest rate of 4%. What does the APR indicate in this scenario? Is it A, the total cost of the loan including fees is higher than the nominal rate? B, the nominal interest rate is the only cost John will pay? C, John will pay less than the nominal interest rate over time? Or D, the APR is irrelevant to John's loan costs? The answer is A, the total cost of the loan including fees is higher than the nominal rate. The APR indicates the total cost of the loan including interest and fees, which is higher than the nominal rate. What is the primary purpose of disclosing the APR to a borrower? Is it A, to show the monthly payment amount? B, to indicate the loan's principal amount? C, to calculate the total interest over the loan term? Or D, to provide a comprehensive view of the loan's total cost? The answer is D, to provide a comprehensive view of the loan's total cost. The primary purpose of disclosing the APR is to provide borrowers with a clear understanding of the total cost of the loan. Sarah is comparing two mortgage offers, one with a lower interest rate but higher fees, and another with a higher interest rate but lower fees. How should she use the APR to decide? Is it A, choose the loan with the lower interest rate regardless of fees? B, select the loan with the lowest fees, ignoring the interest rate? C, compare the APRs to determine which loan has the lower total cost? Or D, focus solely on the loan term to make her decision? The answer is C, compare the APRs to determine which loan has the lower total cost. Sarah should use the APR to compare the total cost of each loan as it includes both interest and fees. Escrow accounts and servicing requirements. What is the primary purpose of an escrow account in mortgage servicing? Is it A, to hold the down payment until closing? B, to collect and pay property taxes and insurance premiums? C, to manage the borrower's monthly mortgage payments? Or D, to secure the lender's interest in the property? The answer is B, to collect and pay property taxes and insurance premiums. Escrow accounts are primarily used to collect and pay property taxes and insurance premiums on behalf of the borrower, ensuring these obligations are met on time. If a borrower has an escrow account, which of the following is the lender not responsible for? Is it A, paying property taxes? B, paying homeowners insurance? C, paying utility bills? Or D, ensuring timely payments of taxes and insurance? The answer is C, paying utility bills. Why this question may seem a bit tricky, it tests understanding of escrow responsibilities. Lenders manage tax and insurance payments, but not the borrower's utility bills. John has an escrow account with his mortgage lender, but he notices his property taxes were paid late. What should John expect from his lender in this situation? Is it A, the lender to cover any penalties incurred? B, John to pay the penalties himself? C, an adjustment in his monthly mortgage payment? Or D, a refund of his escrow contributions? The answer is A, the lender to cover any penalties incurred. Lenders are typically responsible for any penalties due to late payments from escrow accounts, so John should expect the lender to cover any penalties. Adjustable rate mortgages and disclosures. What is the primary feature that distinguishes an adjustable rate mortgage from a fixed rate mortgage? Is it A, the loan term is shorter? B, the interest rate can change over time? C, the monthly payment is always lower? Or D, the loan is only available for primary residences? The answer is B, the interest rate can change over time. An adjustable rate mortgage has an interest rate that can change periodically, unlike a fixed rate mortgage where the rate remains constant throughout the loan term. In an adjustable rate mortgage, what does the cap refer to? Is it A, the initial interest rate offered? B. The minimum payment required. C. The maximum interest rate increase allowed. Or D. The total loan amount available, $2,000. The answer is C. The maximum interest rate increase allowed. Why this question may seem a bit tricky. The term cap might be confused with other limits or thresholds, but it specifically refers to the maximum amount the interest rate can increase at each adjustment period or over the life of the loan. John has an ARM with a 5-1 structure and is concerned about potential rate increases. What should he focus on to understand his future payments? Is it A, the adjustment cap, B, the initial fixed period, C, a loan-to-value ratio, or D, the prepayment penalty? The answer is A, the adjustment cap. John should focus on the adjustment cap, which determines how much the interest rate can increase after the initial fixed period, affecting his future payments. Ethics, fraud prevention, and red flags. What is a common red flag indicating potential mortgage fraud? Is it A, sudden increase in income without documentation, B, consistent employment history, C, multiple credit inquiries, or D, high credit score? The answer is A, sudden increase in income without documentation. A sudden increase in income without documentation is a common red flag for mortgage fraud, as it may indicate falsified information to qualify for a loan. Which action is least likely to be considered a red flag for fraud in a mortgage application? Is it A, inconsistent signatures on documents, B, large down payment, C, unusual property location, or D, frequent changes in employment? The answer is B, large down payment. Why this question may seem a bit tricky. A large down payment might seem suspicious, but it is often a sign of financial stability rather than fraud. John, a loan officer, notices that a client's income documents appear altered. What should John do to address this potential red flag? Is it A, ignore the documents and proceed with the application, B, approve the loan based on other strong factors, C, verify the documents with the employer, or D, ask the client for new documents? The answer is C, verify the documents with the employer. John should verify the authenticity of the documents with the employer to ensure the income information is accurate and not falsified. Which of the following is a key component of an effective fraud prevention program? Is it A, increased marketing efforts, B, higher interest rates, C, more customer incentives, or D, regular training for employees? The answer is D, regular training for employees. Regular training for employees helps them recognize and prevent fraud, making it a crucial part of any fraud prevention program. Sarah, a compliance officer, discovers that a borrower has provided conflicting information on different loan applications. What should Sarah do to address this red flag? Is it A, approve the loan to avoid delays, B, conduct a thorough investigation, C, ignore the discrepancies if the credit score is high, or D, request additional collateral? The answer is B, conduct a thorough investigation. Sarah should conduct a thorough investigation to determine the reason for the discrepancies and ensure compliance with regulations. Fair lending practices and consumer protection. What is the primary purpose of the Equal Credit Opportunity Act? Is it A, to regulate interest rates on loans, B, to prevent discrimination in credit transactions, C, to provide financial education to consumers, or D, to enforce penalties for predatory lending? The answer is B, to prevent discrimination in credit transactions. The ECOA aims to prevent discrimination in credit transactions based on race, color, religion, national origin, sex, marital status, or age? Which of the following is not a protected class under the Fair Housing Act? Is it A, race, B, religion, C, credit score, or D, national origin? The answer is C, credit score. Why this question may seem a bit tricky. The Fair Housing Act covers many protected classes, but credit score is not one of them, even though it affects lending decisions. A loan officer denies a mortgage application because the applicant is 70 years old. What fair lending principle is being violated? Is it A, age discrimination under ECOA, B, income discrimination under FHA, C, creditworthiness discrimination under TILA, or D, marital status discrimination under ECOA? The answer is A, age discrimination under ECOA. The ECOA prohibits discrimination based on age, ensuring that all applicants are treated fairly regardless of their age. Which act requires lenders to provide borrowers with a loan estimate within 3 business days of receiving a loan application? Is it A, Fair Credit Reporting Act, B, Equal Credit Opportunity Act, C, Home Mortgage Disclosure Act, or D, TILA RESPA Integrated Disclosure? The answer is D, TILA RESPA Integrated Disclosure. The TILA RESPA Integrated Disclosure Rule mandates that lenders provide a loan estimate within 3 business days. Advertising and communication ethics. What is the primary ethical concern when using testimonials in advertising? Is it A, ensuring testimonials are entertaining, B, ensuring testimonials are truthful and not misleading, C, ensuring testimonials are from celebrities, or D, ensuring testimonials are visually appealing? The answer is B, ensuring testimonials are truthful and not misleading. The primary ethical concern is ensuring that testimonials are truthful and not misleading, as they can significantly influence consumer decisions. In advertising, what is the ethical implication of using puffery? Is it A, it can mislead consumers by exaggerating product benefits, B, it is always considered deceptive and illegal, C, it ensures consumers are fully informed, or D, it is a form of comparative advertising? The answer is A, it can mislead consumers by exaggerating product benefits. Why this question may seem a bit tricky. Puffery is often legal and accepted, but it can blur the line between exaggeration and deception, raising ethical concerns. A company uses a photo of a famous athlete in their ad without permission, implying endorsement. What ethical issue does this raise? Is it A, it raises issues of product misrepresentation, B, it raises issues of consumer privacy, C, it raises issues of false endorsement, or D, it raises issues of advertising frequency? The answer is C, it raises issues of false endorsement. Using someone's likeness without permission implies false endorsement, which is both unethical and potentially illegal. A marketing team decides to omit negative reviews from their website to maintain a positive image. What ethical principle is at stake? Is it A, the principle of creativity in advertising, B, the principle of competitive advantage, C, the principle of consumer engagement, or D, the principle of honesty in communication? The answer is D, the principle of honesty in communication. Omitting negative reviews can mislead consumers, violating the ethical principle of honesty in communication. Ethical responsibilities of mortgage loan originators. What is the primary ethical responsibility of a mortgage loan originator when dealing with clients? Is it A, act in the best interest of the client, B. Maximize the company's profit. C. Ensure quick loan approval. Or D. Follow only the company's policies. The answer is A. Act in the best interest of the client. The primary ethical responsibility means to act in the best interest of the client, ensuring transparency and honesty in all dealings. A mortgage loan originator is reviewing a client's application. Which action might be considered unethical? Is it A. Clarifying loan terms with the client? B. Requesting additional documentation? C. Altering client information to improve approval chances? Or D. Discussing potential loan options? The answer is C. Altering client information to improve approval chances. Why this question may seem a bit tricky, the options involve actions that might seem routine, but altering documents is unethical regardless of intent. During a meeting, a client asks a mortgage loan originator to omit certain debts to qualify for a better loan rate. What should the originator do? Is it A. Agree to omit the debts to help the client? B. Suggest the client find another originator? C. Ignore the request and proceed with the application? Or D. Explain the importance of accurate reporting and refuse? The answer is D. Explain the importance of accurate reporting and refuse. The originator must maintain integrity by refusing to omit debts, as this would be unethical and illegal. Which regulation primarily governs the ethical responsibilities of mortgage loan originators? Is it A. Fair Credit Reporting Act? B. SAFE Act? C. Truth in Lending Act? Or D. Real Estate Settlement Procedures Act? The answer is B. SAFE Act. The SAFE Act is the primary regulation that governs the ethical responsibilities and licensing of mortgage loan originators.
Finding this exam review helpful? If you haven't already, like and subscribe for more videos that'll get you ready to pass.
Prohibited conduct and conflicts of interest. What is considered a conflict of interest in the context of mortgage lending? Is it A. Offering a lower interest rate to a family member? B. Having a financial stake in a property being financed? C. Providing a client with multiple loan options, ... Or D. Referring a client to a trusted appraiser? The answer is B. Having a financial stake in a property being financed. A conflict of interest occurs when a mortgage professional's personal interests could improperly influence their professional judgment or actions. Which action could be considered prohibited conduct under NMLS regulations? Is it A. Providing a client with a detailed loan estimate? B. Offering a client a promotional interest rate? C. Misrepresenting loan terms to a client? Or D. Charging a fee for loan application processing, then application processing? The answer is C. Misrepresenting loan terms to a client. Why this question may seem a bit tricky, the options include actions that might seem benign, but can violate ethical standards if they involve deceit or misrepresentation. A loan officer, Alex, is considering referring clients to a title company owned by his brother. What ethical consideration should Alex be aware of? Is it A. Potential conflict of interest due to family ties? B. The legality of the title company's operations? C. The quality of service provided by the title company? Or D. The cost of services provided by the title company? The answer is A. Potential conflict of interest due to family ties. Referring clients to a business owned by a relative can create a conflict of interest, as it may influence Alex's professional judgment. Jamie, a mortgage broker, receives a gift from a client after closing a deal. What should Jamie consider regarding this gift? Is it A. The monetary value of the gift? B. the client's satisfaction with the service. C. The timing of the gift in relation to the deal closure. Or D. The potential influence of the gift on future decisions. The answer is D. The potential influence of the gift on future decisions. Accepting gifts from clients can be seen as a conflict of interest, especially if it influences future professional decisions. Uniform state content, SAFE Act and state laws. SAFE Act provisions and NMLS licensing requirements. What is the primary purpose of the SAFE Act? Is it A. To establish minimum standards for licensing mortgage loan originators? B. To regulate interest rates on mortgage loans? C. To provide financial assistance to mortgage borrowers? Or D. To eliminate all state-specific mortgage regulations? The answer is A. To establish minimum standards for licensing mortgage loan originators. The SAFE Act was enacted to enhance consumer protection and reduce fraud by establishing minimum standards for the licensing and registration of mortgage loan originators. Under the SAFE Act, which entity is responsible for maintaining the NMLS? Is it A. Federal Reserve, B. Conference of State Bank Supervisors, C. Consumer Financial Protection Bureau, or D. Department of Housing and Urban Development? The answer is B. Conference of State Bank Supervisors. Why this question may seem a bit tricky. The NMLS is maintained by the Conference of State Bank Supervisors and the American Association of Residential Mortgage Regulators, not a federal agency. Sarah, a mortgage loan originator, is applying for her NMLS license renewal, but has not completed her continuing education requirements. What should she do to comply with the SAFE Act? Is it A. Submit her renewal application without completing education? B. Request an exemption from the education requirements? C. Complete her continuing education before renewing? Or D. Renew her license and complete education later? The answer is C. Complete her continuing education before renewing. Sarah must complete her continuing education requirements before renewing her license, as the SAFE Act mandates ongoing education for license renewal. What is required for a mortgage loan originator to obtain an NMLS license under the SAFE Act? Is it A. Only a background check? B. Only pre-licensing education? C. Only passing a written test? Or D. Passing a written test, completing education, and a background check? The answer is D. Passing a written test, completing education, and a background check. To obtain an NMLS license, an applicant must pass a written test, complete pre-licensing education, and undergo a background check. State regulatory authority and enforcement. What is the primary purpose of the state regulatory authority under the SAFE Act? Is it A. To oversee and enforce compliance with the SAFE Act? B. To provide financial assistance to mortgage loan originators? C. To set interest rates for mortgage loans? Or D. To approve all mortgage loan applications? The answer is A. To oversee and enforce compliance with the SAFE Act. The primary purpose of the state regulatory authority is to oversee and enforce compliance with the SAFE Act, ensuring that mortgage loan originators operate within legal and ethical standards. Which of the following actions can a state regulatory authority take if a mortgage loan originator violates the SAFE Act? Is it A. Impose criminal penalties? B. Settle disputes between borrowers and lenders? C. Suspend or revoke the license of the originator? Or D. Modify the terms of existing loans? The answer is C. Suspend or revoke the license of the originator. Why this question may seem a bit tricky. The options include actions that seem regulatory, but only suspension or revocation of licenses is directly within the authority's power under the SAFE Act. A mortgage loan originator, Jane, is found to have falsified documents during the loan application process. What action can the state regulatory authority take against Jane? Is it A, impose a fine on the borrower, B, revoke Jane's license, C, require Jane to attend additional training, or D, notify the borrower's employer? The answer is B, revoke Jane's license. The state regulatory authority can suspend or revoke Jane's license due to her violation of the SAFE Act by falsifying documents. Tom, a licensed mortgage loan originator, has been accused of unethical practices. What is the first step the state regulatory authority should take? Is it A, immediately revoke Tom's license, B, issue a public warning about Tom, C, fine Tom for unethical practices, or D, conduct an investigation into the accusations? The answer is D, conduct an investigation into the accusations. The first step is to conduct an investigation to determine the validity of the accusations before taking any enforcement action. State law and regulation variations. What is the primary purpose of the SAFE Act in relation to state law and regulation variations? Is it A, to create uniform state laws for all financial institutions, B, to establish minimum standards for mortgage loan originators, C, to regulate interest rates on mortgage loans, or D, to eliminate all state-specific mortgage regulations? The answer is B, to establish minimum standards for mortgage loan originators. The SAFE Act aims to enhance consumer protection and reduce fraud by establishing minimum standards for mortgage loan originators across states. Under the SAFE Act, which entity is responsible for overseeing the implementation of state-specific mortgage regulations? Is it A, the Federal Reserve, B, the Consumer Financial Protection Bureau, C, state regulatory agencies, or D, the Department of Housing and Urban Development? The answer is C, state regulatory agencies. Why this question may seem a bit tricky. The SAFE Act involves multiple entities, but state regulatory agencies are primarily responsible for implementing state-specific regulations. A mortgage loan originator in California is reviewing state-specific regulations under the SAFE Act. What must they ensure to remain compliant? Is it A, meet both federal and California-specific licensing requirements, B, only adhere to federal licensing requirements, C, follow only the guidelines set by the NMLS, or D, ensure compliance with California's interest rate caps? The answer is A, meet both federal and California-specific licensing requirements. California requires mortgage loan originators to meet both federal and state-specific standards, including additional licensing requirements. Reporting, renewal, and continuing education. What is the minimum number of hours of continuing education required annually for a licensed mortgage loan originator under the SAFE Act? Is it A, 4 hours, B, 8 hours, C, 12 hours, or D, 16 hours? The answer is B, 8 hours. The SAFE Act requires licensed mortgage loan originators to complete at least 8 hours of continuing education annually to maintain their licenses. Which of the following is not a requirement for the renewal of a mortgage loan originator license under the SAFE Act? Is it A, payment of renewal fees, B, completion of continuing education, C, passing a new licensing exam, or D, maintaining a surety bond? The answer is C, passing a new licensing exam. Why this question may seem a bit tricky. The question asks for what is not required, which can be confusing. Passing a new licensing exam is not required for renewal, unlike continuing education and fee payment. John, a licensed mortgage loan originator, completed his continuing education in December but forgot to submit his renewal application by the deadline. What should he do to maintain his license? Is it A, submit a late renewal application immediately? B, wait until next year to renew? C, reapply for a new license? Or D, ignore the renewal and continue working? The answer is A, submit a late renewal application immediately. John should submit a late renewal application as soon as possible to avoid further penalties or the need to reapply for a new license.
Thanks for watching. If you found this exam review helpful, be sure to subscribe for more real-world practice and topic-focused study videos. And visit birdsey.ai to start your free trial of Birdsey, your AI-powered study partner.